I think everyone is here still. So we continue with the underwriting arrangement. When you are talking to the investment banker, in order to manage your IPO, you need to have a formal contract with them. And this formal contract can be developed based on two options. Option number one is called firm commitment. Option number two is called best effort. The firm commitment is a commitment given by the underwriter or investment banker to buy the securities from the issuing company, then resell them to the public. If their shares are unsold, investment banker will take the risk. They will buy those unsold issue. So what is a firm commitment? It's a 100% commitment given from the investment banker to the issuing company that we will make sure that all of your shares are sold to the market. Because the firm commitment, since it is a highly risky job, investment banker will charge you higher spread. They will charge you higher commission because they are giving you 100% commitment. The other one is very clear from the name itself, best effort. Investment banker will not take 100% risk. They will try their best to sell the share to the market. So underwriters agree to sell as much of the issue as possible, but do not guarantee the sale of the entire issue. If there is anything unsold, the company will take it back. Less risky, this is generally less risky for the investment banker. Therefore, it is less profitable, meaning that less spread for the investment banker. So when you're talking to the investment banker, there are two options available. One is firm commitment. The other one is best effort commitment. Okay, the next information that you need to know is when you're dealing with IPO offers, there are different stages that you go through. Okay, let me take you through the. Okay, let me explain it here. When for the first time you issue share, let's say you have. Remember, we are talking about $10. Sorry, 10 share, a market lot, multiplied by $1 per share, and let's say multiplied by 10,000 lot you are selling. This is the total amount of capital you are expecting to collect from the market. I hope everyone is here. Okay. So what is the total amount that you are expecting to collect from this issue? 10,000 multiplied by 10 is 100,000. So altogether, let's say $100,000 that you are expecting to collect from the IPO. Now this $100,000, let me just assume that this is $100,000. This $100,000, let's say you do not need the entire money now because IPO application is expensive, it's time consuming, so you do not want to apply every other month. So let's say I divide it by 2. 50,000 will be offered now. 50% will be offered now. Another 50% you can keep it for later. So 50% of 100,000 is $50,000. It will be offered now, and this 50% that you're offering now is called the general IPO. Okay, or often called the cash offer. So it's a sale of securities open to all investors by an already public company. It's a general cash offer, 50%. And the remaining 50% that you are keeping for future is called a shelf registration. Shelf registration means it's a procedure to allow firms to file one registration statement for several issues. So when you do 50-50, you are dividing 50% now, 50% later. Keeping this thing for later, you have to have a shelf registration. If you do shelf registration, you can keep 50% or whatever amount you decide for future issue. Whatever you are keeping for future, let's say 50% you are keeping for future, is called season offering. Season offering. Sale of securities by a firm that is already publicly traded. So you have already 50% traded in the market. Another 50% that you will be collecting later will be called season offering. Sometimes they also call it seasonal issue. Seasonal issue or season offering. In brief, it is called SEO. Sometimes you may see IPO and SEO. SEO means season equity offering. Season equity offering is called SEO. So remember, IPO is the first one. Any other issue part of the IPO that we're keeping for future would be called SEO. And then there is another one, private placement. We already talked about private placement, and we will give you another example of private placement later. Private placement is sale of securities to a limited number of investors. Those are privately managed by you, not publicly managed, without a public offering. So if you go to public offering, we call it IPO. If you go to private placement, privately managed investors, we call it private placement or direct listing. What is the underwriting spread? Remember, this is the most important return to the investment banker. So what is the spread or return they charge? So Alibaba Group is the largest IPO so far. It's actually the second largest IPO now, $21 billion. First largest IPO, number one IPO in the world is Aramco. Saudi Aramco is the largest IPO in the world. So Alibaba Group, 1.2% spread charged by their investment banker, 6% charged on Virgin America. Just we are looking randomly into the rates. 7% charged for the Bellisum, Histogenesis, and Park Energy. Histogenics and Park Energy. These, I'm not sure who are the investment banker, but this is the rate they have charged. You can see that the issue amount is quite small. That's why the spread is also quite high. Now look at the Hilton Worldwide. The issue amount is slightly higher. The underwriting spread is also very low. So depending on the company relationship and also who is the company issuing, who is the company is the investment banker, depending on the relationship, they will charge or decide the underwriting spread. Now this 1.2% of $21 billion is a huge amount of money. Just from one issue, the investment banker earned a lot of commission. Okay, total direct cost of raising capital. Now different types of capital are compared here: IPO, SEO, convertibles, and bonds. And when we compared, we will look into the size. Proceeds in $1 million, less than 250 million to 3,000 million and up, means $3 billion and up. If you are raising less amount of money, cost is the highest. So the IPO cost is always the high. IPO cost is always the high. The highest one is 8%, 8 to 8.5%. But it becomes relatively lesser, around 7.5%, when you are raising $3 billion and up. The lowest cost, however, is bond. Lowest cost of issuing is bond. Now, bond issuing cost is low, but bonds interest might be higher. Okay, so always remember that bond generally, the issue cost is low because bond does not go through the similar IPO process as a stock. The others would be convertible bond. It's also very costly. And SEO, the season equity offering. So first time, when you offer first time is 8.5%. When you offer second time and the number of times after that subsequent time is also called is the rate of 4.5%. So the difference is almost 4% less. From the IPO to SEO, 4% less. So that's why you will issue a huge amount of IPO and then you divide it into SEOs, smaller number of units through shelf registration so that you can reduce your cost in the future. Okay, last one is stage 3. You can do private placement, and we compare this with the public issues. In a public issue, you go through IPO market, remember, and you go through investment banker, they will do everything for you. In private placement, you go through private channel. You will use your investment bankers to organize the sale for you, and they will talk to qualified institutional buyer to sell, to buy your share. The private placement is opposed to the public issue, is a method to sell securities to a limited number of qualified investors without a public offering. So without going through the public offering, you will sell your share to privately managed qualified investors. Now, private placement does not follow regular IPO process. We know this. Thus, it can save time and also cost of issuance. But since it does not follow IPO process, the amount of money that you can raise from private placement will be much lesser, because private placement is organized through private investors, and these private investors have much limited capacity than the public. Therefore, the amount of issue size, the amount you can raise from private placement would be lesser than public issue. A private placement excludes general public. The targeted amount to be raised will be much lesser than the public issue. And after investors receiving the share, their private placement, through the private placement, they cannot immediately trade in financial market. Remember, I told you a lock-in period. This is the lock-in period, say for 3 years, until which the share from the private placement cannot enter the secondary market. So in order to trade in the secondary market, you have to wait at least 3 years before you can go to the secondary market and sell it to the investors. Now, who are these qualified institutional buyers? Generally, the banks, insurance company, pension fund. These qualified institutional buyers must be under SEC rule of Securities and Exchange Commission rule of 144A to purchase and trade private placement. So in order to participate in private placement, this institutional buyer has to have a license by 144A SEC rule. Okay, so in a private placement, once again, what you do, you privately manage your buyer, and these buyers would be qualified institutional buyer, bankers, insurance companies, leasing companies, pension funds, mutual funds. They would buy from you, and then the problem is you won't be able to collect the huge amount of money that you could collect from public issue, from IPO. The cost of private placement will be lesser because you are not having this long process. You don't have to involve with a lot of people. Therefore, cost is also low. But private placement can be a little bit expensive in terms of opportunity cost, meaning that you could collect much higher amount of money, but you are actually collecting lesser. And the investors who receive the share from private placement, they won't be able to sell the share for the first 2-3 years during the lock-in period because of the regulation. And during this time, the share does not have any liquidity at all. So all these steps have positive and negative sides, and depending on the type of companies, you need to match your cost and choose the process that is most applicable to you. It is not kind of like a bed of roses kind of scenario. You need to understand the market before you reach to the market for collecting funds. Small companies struggle the most. They go to venture capital or entrepreneurship funding or crowdfunding in order to collect their funds. Gradually, when they become bigger, there will be more funds available. Remember, when we were discussing about corporation issuing securities, we did not discuss about debt market or bank market. Bank market is excluded here. We have only discussed about the marketplace, financial marketplace, where you can issue your securities to collect funds. We have not also discussed private equity, major investment source for problem companies. Private equities are generally outside of the market. That's why we have not discussed it here. So these are the alternatives, at least 3 major alternatives: venture capital, public market, and private market for the companies those are participating in the market to collect their funds. And these funds, depending on the type of company you have, will have different complex procedure. In order to complete this procedure, you have to take help from different experts. The cost structure is also different depending on how much your company can pay to the investors, you will choose the alternative funding procedure. Also, it depends on what kind of market you are operating in. You are in a large market, good market, structured market, you'll be able to get a lot of fund from those structured market. For example, US, Europe, Japan, China, Hong Kong, Singapore. Hong Kong market is going down because of the unrest in Hong Kong, but still a strong market. But if you're going to smaller, relatively smaller market, for example, Malaysia, Indonesia, Vietnam, Taiwan, India, these markets are still growing, still very big market, but it's still growing in terms of regulation and structure. In these markets, you may have lesser options available. Okay, we will complete this chapter here. We have already uploaded the case for you. Read the case on JetBlue Airways to understand the IPO procedure that JetBlue went through. The discussion that we had today in the second part of the chapter, you will have a lot of similarity of discussion with the JetBlue case. Let me close this session and we will take a small break, 5 minutes break, to start the session number 3. Now, obviously, we cannot finish this session today. If I want, I can, but I don't want to push you that much because the topic, even though the chapter looks like a small chapter, but there are a lot of topics here. Our next session is, next topic is one of the most important topic in strategic finance, is the working capital management, and why it is one of the most important thing that in most cases we ignore the fact that the short-term capital should be managed properly. This is about short-term asset and liability. Working capital is about short-term asset and liability. So sometimes people think that long-term is the one you should manage properly. Short-term one we often ignore. So let's take 5 minutes break, roughly around 5 minutes. I'll come back before 5 minutes. We'll start with working capital management. This is topic 3. And obviously there will be a lot of cases, mini cases I will upload later as tutorials. And I will show you some example while we are finishing the course, finishing the chapter. And also I'll give you additional example to practice. Let's come back at 10:42. Now it's 38. We'll come back at 10:42 with working capital management.